Hello, everyone, and welcome to Resolve's 12 Days of Investment Wisdom miniseries, where Michael Philbrick, Adam Butler, Jason Russell, and myself, Rodrigo Gordillo, will explore timeless, evergreen principles that will help you and your clients achieve long-term investment success. From the importance of asset allocation, thoughtful portfolio construction, and maximum diversification, our aim is to offer you a comprehensive framework for a more thoughtful investment approach that may change the way you view the complex arena of investing altogether. We hope that you enjoy this series as much as we enjoyed putting it together.
Mike Philbrick, Adam Butler, Rodrigo Gordillo, and Jason Russell are principals of Resolve Asset Management. Due to industry regulations, they will not discuss any of Resolve's funds on this podcast. All opinions expressed by the principals are solely their own opinion and do not express the opinion of Resolve Asset Management. This podcast is for information purposes only and should not be relied upon as a basis for investment decisions. For more information, visit investresolve.com.
All right, welcome back. Hot on the heels of our discussion on capital efficiency, the prudent investor rule, the role of a fiduciary in that, how you might think about vol targeting, and a whole suite of opportunities to actually impact client portfolios in a positive way. But they do provide some discomfort. And so today we're going to talk about getting comfortable with being uncomfortable.
That's right. Yeah. And specifically, we're going to talk about the axis of discomfort, which is really the reality facing many retirees or those who are approaching retirement at the moment, where you've got a future of fairly low returns given current valuations on domestic U.S. equities and high-grade bonds. So you've got to make some choices. You're going to be uncomfortable because you've got to increase your savings rate in order to save more for retirement because you can't expect to get the same returns that we've seen historically. Alternatively, you can reduce your expectations for retirement lifestyle or maybe push out your expected retirement age. If you're expecting to retire at 62 or 63, maybe you push that out to 65 or 66. And then the other potential step you can take is to take a step into things that are less familiar, whether that means embracing global investments. Maybe that just means foreign stock markets. Maybe it means emerging markets or emerging market bonds. And then also considering alternative sources of returns, a lot of which we've discussed in fairly great detail in previous podcasts. So that's the axis of discomfort. Increase savings, reduce your retirement lifestyle expectations, or embrace unfamiliar investment categories.
And I think this is particularly acute when you actually look at the assumptions that are going in to the financial plans or actuarial calculations on these assets with long-term purposes like those for retirement and pension funds. So if you look at the individual investor right now, they're putting 10.2% as the expected
in surveys,
in surveys into their expected return. And, this reflects recency bias, home country bias. There's a whole myriad of items that are reflecting that. You then have a slightly more thoughtful pension industry that is saying, well, we think it's 7.5. We would sort of still be a little bit eyes wide open, looking left and looking right on that number. And then finally, you've got Vanguard, who is currently suggesting that, probably a good estimate is half of the average historical return on global assets, equity assets of, sort of 4.5 to 6.5%.
And that's on global. So that's right. Already going out on the more uncomfortable limb.
Right. That is that first step that we talk about. And of course, let's talk about getting uncomfortable. So we know that there's a large home country bias across the world. You go through any country in the world and people generally like to own what they see every day. They have familiarity with it. There's just this, I know what it is. This feeling of comfortable. It's a halo effect. And what's so interesting is I had the opportunity to sit in on a seminar with Professor Schiller, and they were launching a product in Canada. And so there was a room full of portfolio managers. There was probably maybe 100 of us there. So representing billions of dollars in AUM. And came to the question and answer period. And Schiller is there, taking questions. The portfolio manager thoughtfully puts his hand in the air and says, well, given that the current CAPE ratio for American equities is approaching 30, 28 or whatever it was at the time, what should we do? Everything's expensive. How should we operate? And Shiller paused and
he says there's nothing because nothing's cheap. What should we invest in?
Yeah, what should we invest in? And Shiller tilts his head and says, well, nothing's cheap? He said, well, no, you have CAPE ratios in Russia, and Czech Republic, and Turkey, and Greece that are in the 5 to 9 range.
Mid-single digits.
Yeah. And so there's lots cheap. And with no word of a lie, the whole room sort of scoffed and chuckled. Together, they just scoffed like, no one can do that. Well, of course, no one can do it. That's where the excess risk premium lies. That's why it's there, because it's hard to do. It is uncomfortable.
But it is uncomfortable, and it's crazy how that home country bias works everywhere, right? We were just sitting down with one of our newest employees who's fresh out of the U.S., and I was telling him about how in Peru there's a huge home country bias, and he's like, "What? I thought that the global default was to invest most of your money in the S&P 500." No, the vast majority of Peruvian investors, like over 90%, goes into the Lima Stock Exchange, right? We think it's kind of silly that Canadians, who represent 2.5% of global market cap, invest. What is the number? One of the largest banks.
Yeah. So my buddy is the head of retail at one of the major Canadian banks. So I just asked him a couple of years ago to go through their total wealth book and identify what percentage of their assets from Canadian investors are invested in Canadian assets, Canadian stocks and bonds. And his analysis suggested that 87% of their wealth book is in Canadian stocks and bonds. 87%, again, right, reiterating that Canadian stocks and bonds represent about 2.5% of total global market cap. So again, just reiterating that.
And the Peruvian stock market's
bias.
A fraction of that, and the same thing happens. So we get it. This is a real thing, and we have to manage to that, right?
What it provides, though, is it provides for a willing loser. It provides for someone who wants a certain amount of comfort and is willing to give up excess returns to those who are willing to be more thoughtful about diversification across many different domains and axioms, right? So this is an opportunity, but we've got to get our heads around that. We've got to get our heads around being comfortable, learning right down to the grassroots, because when it doesn't work, which the last 10 years is representative of that, if you're a U.S. investor and you've had that U.S. home country bias, it's been a huge tailwind. There has been nowhere else in the world to bother
diversification is not paid.
Yeah. And so what you don't want to do is give up on diversification precisely at the wrong time. You absorb all the risk and you get none of the returns. And so global is one thing, but then it goes into what we've talked about, which are all the other alternative options. Leverage aversion. Okay, should I be using leverage in portfolios to target volatility like we talked about in the last episode? Like all of these are, they're going to require that you stretch a little bit. But the stretch is worth it, in our opinion. We would urge you to consider it.
Well,
anyway.
you need to stretch from the point of comfort that you're in. So if you have done zero, I think it's going to be difficult to convince anybody that has been in the business for 20 years to start adding 50, 60, 70, 80, 90, 100% of this stuff. So there is a reality out there that the vast majority of retail money out there has been used to a certain type of investing, signed up for something very, very different than what we're espousing. And we got to take that into account, right? There is that.
Absolutely.
If you are that advisor, then you are still going to be uncomfortable. You're going to be comfortable in that you're going to continue to espouse what you've always espoused. But now you have to have the uncomfortable conversation with investors of what they need to do in order to stick to that type of portfolio. And that is saving more, spending less, working later.
It could be.
So that's fine. That's the idea of getting comfortable being uncomfortable. And you're minimizing tracking error. You're giving them a level of comfort in what they own, but there's the discomfort on the other side.
The important takeaway really is that it's incumbent on advisors who sit at the nexus of their client success to have an honest, candid conversation with each client about the realities that they're facing. What specifically are those realities? Well, on the bond side, we know what we can expect for returns on high-grade bonds. For example, if you look at the Barclays Aggregate Bond Index, the current yield to maturity is 3.44%. And so over the next 10 or 11 years, that's what investors should expect on global bonds. We know that Vanguard expects 4.5%-ish on U.S. equities, maybe slightly higher on certain very cheap foreign equity markets. But we're sort of in the neighborhood of 5, 6, maybe 7% if you really want to push out the risk spectrum on global equity markets, anchored against a 3.5% return on bonds. So a 60-40 portfolio, you're looking at somewhere in the neighborhood of 4.5%. That's before fees and taxes. So, I mean, these are just, we're not really pushing the envelope here. We're using Vanguard estimates. These are right down the fairway. We could really use aggressively pessimistic estimates. That's not really where our point. The point is find a reasonable estimate for returns, have candid conversations with your clients, and then allow clients to determine what balance along this axis of discomfort is right for them.
What's
right?
the utility function, right? We're not trying to espouse that there's one way. There's one optimal way of investing clients' money. I mean, there's a difference between maximizing the time-weighted rate of return and maximizing the money-weighted rate of return, right? And what we want to emphasize is that what you need to do is you need to educate your clients and employ a methodology for your clients that's going to maximize their chances of success.
Yep.
And that is a combination of all three. I mean, I have no belief that we're going to get almost anybody in this podcast, listening to this podcast, to do 100% global alternatives. There's going to be a very, very few amount of advisors that are going to do that. And it's because they understand their clients better than anybody else.
It's not just advisors, it's pension allocators too. They have career risk in deviating too much from the reference portfolio generally provided in their industry. And I do think that if you are in that position, whether you're advising pools of allocated long-term assets or individual assets, figuring out the tracking error that the person or entity is most susceptible to is of paramount importance. So if someone has a number of friends and they're all Apple employees, well, if you sell their Apple for them and all of it because you want to diversify and all of their friends are still holding their Apple stock, you're going to be a very unpopular advisor, even though you're trying to do the right thing by diversifying their portfolio. So understanding what the tracking error is, what the minimum effective dose is. So what I want to do is I want to buy their tracking error with the absolute what's going to keep them on plan.
That's right. Yeah.
And that's the amount I want to own, and that's going to be a nuanced conversation. That's why you're a professional. That's why you're a craftsman.
And you're never going to get it exactly right.
Exactly. And so then that becomes one part of the portfolio, and they'll say to you, "Well, this is doing that," and you say, "Yes, there it is. It's exactly that. It tracks that tracking area. It's exactly that. Whether it's S&P 500, then buy an S&P 500 cheap ETF. Great." So we've got the tracking error taken care of. Now we need to manage the rest of the portfolio around that, optimizing that portfolio for actually taking into account that tracking error issue, right? So if it's a large US stock index or individual security, then you should factor that into the rest of the allocation throughout the portfolio. And then you should think about diversifying across global asset classes, alternative strategies, factor premias, to the extent that you're able to. If you're in the position of being a fiduciary, you have more flexibility and actually a higher standard that you are required to meet. And again, all of this is, by the way, advisors, if you're kind of squiggling around in your chair and you're feeling a little uncomfortable, it's time to get comfortable with feeling uncomfortable. Because this is, I get it. It's uncomfortable. No doubt. What we're trying to do is provide some framework to help you convey these ideas to your clients to really get traction where the rubber meets the road. What we don't want to have happen, and Nassim Taleb tells this story the best, what I don't want you to be is the turkey, right? I get it. U.S. stocks have done really, really well over the last 10 years. It has not paid to diversify. Alternate risk premium and style premium have not done well in 2018. I don't think anything's done well in 2018. Okay, so now let's lay that over the life of a turkey. The turkey's born. He's nurtured by the farmer. He's fed by him every day. The pen is guarded to keep the foxes out in order to have that turkey reach its full potential.
And when the turkey crunches the numbers, He sees that with a higher level of confidence.
Every single day, he becomes more and more confident.
There's more data to back up the fact that they are truly loved by their masters.
Correct. And then Thanksgiving comes, followed by Christmas. Boy, it is a tough 6 weeks. It's a tough 6 weeks in the turkey world right now. We're right in the heart of the toughest. So, you have all this, the turkey has all this data reinforcing the bias that he already has, which I feel is the same sort of thing going on in markets in a number of circumstances. And by the way, if we go back through time, this is something that rhymes. The bricks, the Grimples, the diversification of 2000, which was, Sun Microsoft.
The Nifty 50.
Yeah, exactly. And the Nifty 50 is a great example. So this is not new. We have past precedent for this. And so I think, on that note, don't be the turkey.
Sure. I just want to add one more thing before we go. I mean, we're talking about getting comfortable, being uncomfortable. And this just came to me. Investing is uncomfortable always, whether you're 100% domestic equity bond investor or not. The difference is that sometimes the dosage varies. And so it can be comfortable. For 10 years, it's been very comfortable. But we all felt, anybody that thinks back to the great financial crisis, that dose of uncomfortability was
discomfort.
Thank you.
I like uncomfortability.
Let's go with that one.
That's a real word in Spanish. That level of discomfort was massive. Sure. I remember advisors not being able to return the calls for their clients, where they were just not coming into work. Clients not looking at their statements for months on end. The level of... I had
advisors calling me at 4 a.m. for conversations about what was going on in Asia. That was definitely above.
Everybody was getting therapy. You were going to get a big whopping dose of discomfort. Mm-hmm. The question is, do you want to kind of dole it out a little bit every year by being this type of uncomfortable, or do you want it to happen like the turkey? And so, it's always uncomfortable. I think we need to...
That is a great piece of insight. Here's what I've learned over however many years I've been doing this.
How many is it?
I don't want to say. It's 20 something. And when I'm feeling comfortable, I'm terrified.
Oh, that's so true.
And when I'm uncomfortable, I'm kind of like, this is pretty good. This is going to turn around.
I'm very excited right now.
Yeah, me too. Me too. It is the time to evaluate these types of strategies. It is again, if you would like to get the superior money-weighted rates of return, and keep in mind at Resolve, we always talk about what our goal is. We want to be in the Hall of Fame for risk-adjusted returns for our clients. And
realized risk-adjusted returns.
Realized risk-adjusted returns. Yep. And in order to do that, there's a certain discipline and rigor that's required, and there's a certain amount of acting in the face of what looks to be daunting facts and figures. And it's
a massive amount of education that goes along with it. Right?
Yeah, without a doubt.
We are seeing inflows for some of the strategies that we talk about the most in the worst possible.
That's part of the hard work, or part of the discomfort is some of the hard work that's required in order to learn about these alternative sources of return and when they struggle and when they thrive and how to put the pieces together. These are, if you're not motivated or passionate about these topics, and it's hard work and it's uncomfortable, but that's just another source of edge.
Yeah. Is it a shock that we're going through this style premia bear market, if you will, at the point where we have a market capitalization bull market? And if you go back to 1999, there was a similar set of circumstances that occurred where there was one set of portfolios that worked. It was market cap. It was a U.S. dominated market. There was a tech bubble going on at the same time.
Well, isn't value dead right now? Like it's dead forever, right?
And quality was dead back then.
That's right.
Too.
Quality and value were dead
at the maximum point of underperformance.
Warren Buffett was totally lost.
Had lost his stuff.
Had underperformed by 69% over the period around 99, 2000.
Yeah. But did he flinch? Did he go away from the idea of investing in quality companies for the long run? Did he blink? He did not blink. And what's interesting in this go around, it's the defensive type stocks that Mr. Buffett would normally buy that have actually participated the most and have had a coincident rally with U.S. equities. But there are factor premiums that are really kind of decimated. You know, if you look at the 10-year rolling return for trend or value, it's been quite a tough go. And that, to me, that's what gets me excited.
What happened right after is that the best managers were value managers during the 2003 tech crisis, right?
Yeah.
That's where you wanted to go. Anyhow, I think we've beaten that horse to death.
All right.
Cool. So that is it for episode 8. We have 4 more to go. And we will be talking about a random series of very important topics for practitioners. So stay tuned. We look forward to seeing you next time. Thank you for listening to our 12 Days of Investment Wisdom mini-series. You will find all the information we highlighted in this episode in the show notes at investresolve.com/12 days. You can also learn more about Resolve's approach to investing by going to our website and research blog at investresolve.com, where you will find over 200 articles that cover a wide array of important topics in the area of investing. We also encourage you to engage with the whole team on Twitter by searching the handle @InvestResolve and following Adam, Mike, and myself. If you're really enjoying this series, please take the time to share us with your friends through email, social media, and if you really learned something new and believe that our series would be helpful to others, we would be incredibly grateful if you could leave us a review on iTunes. Thanks again, and see you next time.